What's going on, everybody? Are we live? Are we in the stream? I gotta get these posts updated. What's going on, everybody? Can you hear me? Can you hear me? It is early. Awesome. We're good. Yes. We are good. We are good to go. All right, guys. We got 40 minutes. So I just wanted to come on here early and hang out. 40 minutes till the earnings drop. Good morning, everybody. 40 minutes left. Okay. 7 o'clock, the earnings drop. 8 a.m., we have the earnings call. So, this is where we are at right now, man. Remember last earnings, guys? We were at $7 or like $7.20. So, even though we sold off a little bit or whatever, I mean, look, we're $4 higher heading into this earnings. So, I know a lot of people, it looks like the market is preparing for a really good earnings. You know what I mean? That's why the stock's up $4 on top of, that big rate cut. But I think it's going to be a good earnings. I wasn't extremely confident in Q2. I thought it was going to be like a decent quarter in Q2. I was like, wow, for what they said they were going to do, this is a pretty good quarter. They hit a new high of revenue at $600 million. So I just think this is going to be not a blowout, but this is going to be a great quarter. Guys, if you can do me one favor, since my Twitter got hacked, I can't really promote the YouTube channel at all. If you guys can just post the YouTube link on StockTwits and post it on Twitter with the tag Sofi, just post it out there into the open so we can get a lot of people on this live stream by the time they drop the call. I mean, that'll be a great help. My Twitter's gone, guys. I lost it. Can't do anything about it. So that'd be really, really great if you could do that. So I think S&P 500 is going to happen in 2025. Some people are saying crazy. I think by the time SoFi hits their seventh quarter in a row of profitability, I think we'll be over $18 100%. We're going to head into the SP 500 into 2025. I just got that feeling, guys. I'm telling you, I have that feeling. It's not going to be 2026. Noto is about to kick everything into overdrive. Earnings drops, the numbers drop in 35 minutes, 7 a.m. Eastern time. 35 minutes. That is correct. So this is gonna be awesome, guys. This is gonna be an awesome quarter. What are we looking for, guys? So it just sucks because you can look for something on your Q3 earnings, like something you really think that's gonna make the stock pop, but you always have to match it up with guidance. That's the part that sucks. You know what I mean? So I think this stock's gonna start moving up. If we creep anything over like 660, I think that'll get the stock launching. Anything over 660 million in revenue. Because last quarter we did 600. So think about that, guys. That's a $60 million quarter over quarter jump. If we get anywhere in the 660 range, that's 60 million jump, okay? That's going to get the stock moving, okay? Profitability, I don't think they blow out their guidance on profitability, but we had 17 million last quarter. If we clip over 50, that's a massive quarter over quarter jump. So We need about 660 revenue and 50 million net income. That's what we need. Okay. That's gonna get that's just the beginning of what you need. Then we got to go over to the guidance. And I think we need to be pushing at least like exactly the same numbers at a minimum. You know what I mean? Like to say, well, hey, because the analysts have it that the numbers are going to go backwards somehow. Like the EPS is going to go from like 4 cents to 3 cents. So we just need to match whatever we just did at the minimum. You know what I mean? So like maybe a 660, 670 Q4 revenue just as a guidance, and then 50 million, 55 million profit or something like that. That's what we need to see at a minimum, to get everything flowing right. Because I'm telling you guys, they think SoFi is going backwards. I just don't see SoFi planning on going backwards after the 50 basis point rate cut, potential another rate cut, the deal they got with Fortress, and the convertible note opening up, their lending capacity. Why would they go backwards in Q4 like these analysts are saying? Why would they do that? It makes no sense. So I don't know, guys. I'm very, very excited. If you could do me smash the like button on this video. Let's try and get this video to 1,000 likes. Find the like button and don't forget to subscribe to the channel if you are not already subscribed. Guys, if you just look at how the stock's reacting, it's already reacting a little different as of the last like 2 days heading into earnings. Like we had a little decent pump last earnings. I remember like 3-4% like going into earnings. Like this time, like the stock is acting a little bit weird, selling off right after the close. No pre-market run up right now, just red. I don't know, guys. The stock's it's acting a little weird compared to last earnings. I'm excited. I think that Noto's been silent on his Twitter for about 4 days. I think he's locked in. He ain't talking to nobody. I think he's gonna drop something. Will we get some Galileo partnership news? I'd say 30%, 25% chance. 25% chance they announce like a massive partner, 1 in 4. Okay, so I don't know if it's gonna happen yet, but if that happens, that means Noto is really trying to work the stock up, like get into those bonus ranges, 25, 35, 45. If he announces any Galileo news, the dude's only worried about the stock. I'd say it's a 25% chance he does it right now. Maybe he thinks he can get the stock up on just some earnings guidance. But if he thinks, guidance won't be enough, maybe, I don't know. Galileo news could definitely get everything rolling, because that's like the tech multiple. That's what we're waiting on. You know what I mean? Yes, 30 minutes to go. Members, growth, net interest, income numbers. Got it. Too early for hype, Kyle. Yeah, I gotta, guys. This is just, it's a lot of anticipation. Everybody has money on the line. This shit is serious. You know what I mean? We're not having, you know what I mean? We're not just playing games anymore. This is it. These are the numbers, okay? Bad numbers, you go down 20%. Great numbers, you go up 20%. You know what I'm saying? This is just the quarter, guys, that you're hitting 4 quarters in a row of gap profitability. This has been an unprofitable business for forever. You know what I'm saying? Like they've been in growth mode forever. Anthony Noto took over 2018, 6 years of investment, 2 years in the private market investing in it. This has been a 6-year journey for him. I think they're entering that EPS expansion mode right now. 4 quarters in a row profitability. It's going to put us, in the news for all of these institutions to just start new positions. We still don't even know who is inside the convertible note deal. We don't even know what whales are sitting behind that deal on these, cap calls at $14, $15. We don't even know who's behind that money. You know what I mean? Who is it? We still don't know. And I think Noto chose the top whales out of all their institutions. I think it has to be. I just got that feeling that BlackRock is in on it. You know what I'm saying? They're a top two holder after Vanguard. I just got that feeling that BlackRock's in on that deal. I don't know. Awesome, man. If you're in the green this early, I mean, imagine where you could be at in 2026. You know what I'm saying? You could be looking at a massive home run. Hey, shorts can do whatever they want, but think about it, guys. We're up, 40, 50%, in the past like 90 days. You know what I mean? If they wanted to bring the stock down, they could have brought it down. But we're up 50%. And we have, like I said, them cap call investors inside of the stock that want to see the stock come up. So if they see good numbers, they're going to buy up any dip that the shorts try to bring. If the shorts try to bring this down 5% on great earnings, you think retail's just going to clean it up? Yeah, the retail will try and clean it up, but I'm telling you, there's going to be these whales coming in. They're going to be buying up some dips. So people can say whatever they want, but that's just reality of how it works. 2 years. Nope. 27 minutes. Good morning. Exactly. They're saving a lot of money, and they're going to be able to lend even further. That's going to be the Q4 guidance. We could see everything. Q4 could be where we see everything just hit numbers we couldn't imagine. I mean, Galileo could ramp up 20-25% growth year over year. Financial services could bang out another 80%, and then you might see lending in Q4 like 10% year over year or something crazy, guys. Q4, I'm betting maybe not the guidance, but I'm betting on the numbers when they actually come out. In 90 days, 3 months from now, I'm betting on the numbers being 700 million plus. Good morning. Good morning. Golden cross on 100 and 200 MA on the daily chart right now, Kyle, looking good. So I'm saying stock's looking good. I mean, if Anthony Noto wants to be the top CEO, you can't come out and fumble the bag when your stock's about to break 3-year highs. I mean, you don't think Anthony Noto knows that the stock hasn't ever hit over $11.70 in 3 years? I mean, think about how much pain his retail, holders have gone through. We know when his bonuses are coming. These guys cannot fold right now. They have to get the stock rolling to hit these bonuses. You know what I mean? We have to like literally drop the earnings. The stock needs to automatically gap up to that 1170 and like smash it in 3 seconds. Like it has to break through that crap in literally 3 seconds. I have faith. Remember what he said, guys. He said, "Hey, we're not getting paid right now. We're not going to overstretch our numbers or our guidance because that's going to create even higher risk with your stock not even performing to solid earnings, triple beats and growth." He said, "Hey, we're not getting paid. Stock's not going up. We're not taking the massive risk. We've made a transition out of massive amounts of lending, 95% of the business down to 60. You guys aren't taking it in. We're going to continue to execute." And look what happened, guys. It was a delayed reaction. Boom. We went a little red a day or two later for a week. Stock went from 6 to 11. You see what I mean? Just crazy price action. So it looks like what Anthony Noto was saying, it was a delayed reaction. Now they're getting paid a little bit. So that should tell you Anthony Noto should stretch the guidance a little bit further than they usually. Not that super sandbag, maybe just a little, oh, okay, these guys aren't playing around, warming up even more. See what I mean? So that's what Anthony Noto said. They weren't getting paid. You weren't going to see it on the guidance. I think we're getting paid right now. I think he's ready to surge this bad boy to 3-year highs today. 1170, smash that crap. Let's get to these, next resistant points, 13, 14, 50. These are the 3-year massive resistant points, that we did like a triple top early 2021, hit 15 3 freaking times. So this is where we get to, guys. If you could do me a favor, everybody that's, on the channel right now, I don't have my Twitter. I can't promote my YouTube. It sucks. I used to, my Twitter was doing absolutely amazing. I got hacked. Hopefully I get it back soon. But if you could just retweet this in a stock twit so more people can see it, and retweet it on Twitter. Smash the like button, sub to the channel. Let's get this, live stream booming before these earnings drop. We got 24 minutes, guys, or 23 minutes as of right now. So this is it, guys. This is reality. This is our money. This is our investment. This is it, man. This shit is serious. This is it, man. This is gonna be some crazy volatility. I'm so excited to see the numbers. I wasn't that happy. I wasn't very excited to see the Q2 numbers. They did come out okay. Anthony Noto went live on TV. The stock was up 2% flat. The market didn't really like it. That's okay. This is it, guys. We got the 50 basis point rate cut like he wanted. We got the convertible note deal kicking in Q4, lending expansion. We got the Fortress deal. That could be some 2025 guidance coming in, Q4 guidance. I just don't see a bad earnings report. I don't know. I just don't see it. I think we're gonna blow this one out. SoFi APY higher for longer than Bank of America, Wells, and Citi. Yep, people are switching over. As for members this quarter, freak, I forgot what I put out on my YouTube video. I don't know. I think I was conservative. I might not even have done it, but I'd be happy with like 680. I'd be happy with 680. That's good for me. 10K share strong. Let's go. Lot of loan emails. That's good. So if I shot themselves in the foot by not pumping out lending, so we will be behind a little. That's why they are a little worried. EPS, we need to watch, need a cent beat at least. So guys, what you're looking for on that EPS, you're looking for 4 cents. That's what the street wants. So SoFi needs to come out at 4 cents. That equates to like 45, 50 million bucks. My prediction, because I know they like to beat, I don't know if it's going to be a massive beat. I'd like to see 5 cents. And I think that gets the stock moving, especially if they put like Q4 guidance at 5 cents. That's awesome. And if they come out at 6, 7 for Q4, that's awesome. So we need 5 cents. We need 4. I want 5. Earnings Whisper, I did a YouTube video. I'm sure you guys saw that. Earnings Whisper was at 6. They want a 6 cents. Earnings is in 21 minutes. Not the earnings call, but you actually see the earnings, and then there's a 1 hour delay. You get the earnings call at 8 o'clock. I appreciate it. Please like the video. Let's try and get this bad boy over 1,000 likes. I'm trying to get up to, like 1,000 viewers by the time we get to earnings, but we're looking a little low. We're at 640. We should be at least 1,000. Buy the dip. Let's go. Q4 is going to be amazing. This is our time. It's foot to the gas. Yes. Maybe if the Q3 is even soft, maybe it doesn't even matter, guys. Like, it's a possibility. If Q3 is a little soft, Q4 guidance could come in there and just clean up everything. We've seen many mega caps in the world not react to earnings, and then the guidance accelerated and the stock still moves like crazy. So I don't think that's going to happen. I think Q3 is still going to be solid. I think it's going to be a triple beat. But hey, like this guy's saying, clap my dog. Q4 guidance, I think it's going to be good. I think it's going to be really good. Good morning, Robert. They can, but we have investors that don't care what the shorts think. We have investors short hedging that could cover their shorts. So guys, I think there's just more big long money in this stock now that can destroy these shorts in a matter of time. What are the shorts betting on? Are they betting on SoFi to not go from negative profitability 2023 to $1 billion profit 2026? Is that what they're betting on? Negative 200 million or 100 million to $1 billion profit? That's the bet? That's not a good bet. Negative profitability 2023 to 200 million plus 2024, 500 million 2025. Is that what they're betting on? That's not how the stock market works. You can't bet on a company that's entering an EPS expansion, growing members potentially by 1 million members a quarter. it just doesn't work. They had their macro short, with the interest rates that worked, but I don't know. 2027 leaps. I like it. 5 cents. Calling it. I like it. I'm calling 5 cents. 5 cents. Calling it. Guys, if Q4 is something out of a fairy tale, let's say they say, hey, it's time to get paid. Q4 net income 70 to 80 million. 14 gone. Anything in that 80 million profit range, gone. I'm telling you. If they want to do something like that, bye-bye. 14. I'm telling you, if they have that blowout Q4 guidance, we are gone. Bye-bye. Let's go. Let's go. There you go. Goldman Sachs on board with SoFi. These guys could be on this convertible note deal. It's definitely possible. Hello there. Buy more shares. Let's go. Same. Hello from Florida. Hello from Singapore. What could cause the stock to drop back to 5 or 6? I don't know. I mean, Anthony Noto leaving or SoFi bracing for massive delinquencies, something crazy. I mean, to get to those levels, it'd be a while from here. Hello. Going to war. I got hacked. So if you guys can just retweet this YouTube on Twitter, I know some of you guys got some pretty solid Twitters. Tag the SoFi. Let them know this is the GOAT's YouTube channel. Push it on Twitter and push it on Stock Twits. We got 17 minutes to go, guys. If SoFi hits 6 or 7, I'll load up like never before. I definitely buy 2. Hello from Singapore. 2 people in Singapore. Holy crap. 50K. Ireland. SoFi is serious deal now. Another NVIDIA in the making. I hope so, guys. I mean, long term, I know on my YouTube channel, I have I think there was one video a long time ago I covered like a 10-year, potential profitability. But I've never in my YouTube channel, I know a lot of long-term people are still in here, but I've never really gone out past 2026 to tell you the truth, I've never covered this stock over 2026, over that $1 billion in profit. What if they grow their profit, 40% a year, that you're looking at like a $3-4 billion profit in 2030. You know what I mean? It's something crazy. Like there's companies right now, like $200-300 billion companies. I can't think of the names, but they're not even pulling $4 billion in profit. There's multiple companies like that. So yes, I think this company can get into that, not 10 billion plus profitability, but like in that mid-tier level, 3 to 5 billion profit in like 2030 or something like that. I could easily see that with scale coming. Yeah, guys, a lot of people. I've been looking. I'd say like the comments are like 70% bullish, 30% bearish. Like I see a lot of people bracing for impact, like massive sell off, and yeah, it's gonna suck. We're doing a live video here. It's gonna suck if we sell off, but for us to sell off, it's got to be something bad. You know what I mean? I can see the stock trading flat or like down 3% off some like bullshit shorting, but for us to sell off like 20%, they have to change like, hey, no more foot on the gas. We're bracing for impact. Fed, decisions not clear. Competition, I don't know. To sell off like 20%, it had to be something crazy. Get some coffee. I'm drinking Body Armor right now. There you go. Kamal win in a Black Swan event to get back to 5.6. Selfishly, I want SoFi to sell off more. Time to load the boat cheap. I've heard that so many times, and I like that we're over here at $11. Is it for sure? Is 5 for sure? Is that good? So 5's not for sure. The guidance is 4. So 4 cents is what the Wall Street wants. That's what SoFi. I'll show you guys real quick. Give me a second. Hang on 1 second. I'll be right back. Okay. All right, guys, check this out. Let me show you exactly what you want to look for. We have 13 minutes, guys. I'm starting to feel it. It's about to get serious, guys. Very, very serious. Okay, so check this out. This is the guidance that SoFi put out, okay? They expect net revenue of 625 to 645. So a little bit wider gap than the last quarter. I'll show you real quick what I'm talking about. You can see the gap was only 10 million on the guidance. So why they widen the gap up 20 million, I don't know. Maybe it could come in a little bit softer, but check this out real quick. SoFi beat their revenue last quarter by $32 million on the high end, okay? So as you guys can see right here, this is the $32 million jump. My guidance that I put out, I split this in half, this 32 million increase, over the top end guidance. I did a 15. That's why my revenue projection is 660. I think anything over 660 is amazing, okay? And if you look at gap net income, they want 40 to 45 million dollars. That's about 4 cents on the bottom end or the top end. I think my guidance I put out was $53 million in net income. So that's about 5 cents. So as long as we get over 4 cents or 4 cents, that should be solid. But yes, guys, I'm not looking for the 30 million beat on revenue. I'm looking for a 15 million beat on revenue. A 660. I think that gets us moving. Okay. I think that gets us moving. So that is the guidance. 4 cents in a 645 revenue. And you can see the stock is absolutely no pre-market pump at all. I think we got a pre-market pump last quarter. I think it was like 3-4% or 2-3% green. No pump at all. Overnight, nothing. Stock's completely frozen, flat. Pretty weird. Pretty weird. Just saying. Did Palantir take off after 4 quarters in a row? I think they actually started taking off Q3. But believe it or not, guys, I actually did a deep dive into Palantir, and believe it or not, guys, after the 7th quarter of profitability, 7 quarters in a row, so 3 more after we got right now, the stock was only trading at like $27, $28. What happened was the S&P 500 took Palantir from 28 to 40 instantly. You see what I mean? So I never thought the numbers were out of this world on like profitability and the growth rates for Palantir. I mean, they probably deserved a $28 stock, but that S&P 500 took them straight to 28 to 40. So something to think about. And not even the 7 quarters in a row of profitability got their stock to, where they're at right now. That $12 boost you get on the S&P 500. So think if SoFi is trading at, let's call it $20 or $25, like I said, Q3 2025, and then we get the S&P 500, that takes you from 25 to 37. Now the 2026 45 is looking pretty good. So think about that for a second. S&P 500, $10 boost. There you go. He's talking about the convertible note deal, guys. Goldman and BlackRock. I think BlackRock is in on it. Man, guys, I can't wait to check the institutional buys coming into tomorrow, the next day. Oh, man. This is it, guys. Anthony Noto right now is literally in a room waiting to do the earnings call, and they're all of these presentations, they probably hit the media outlets like, I don't know, probably at like 6:59. I'm guessing they send them out, and then the people drop them at 7. I don't know. I don't think anyone has access to into the numbers of this report until 1 minute prior. Just like the big, media outlets, they just get them the last second before 7 o'clock. That's how I think it works. I don't know, but I don't know about that. Awesome. Good morning. Damn, guys, I am way down on the comments. I am sorry. This I'm 20 minutes behind. I'm sorry. I'm trying to read through all the comments. I'm 20 minutes behind. You guys are commenting so much. I'm sorry about that. Exactly. You're right. That it's not worth it no more. We need to be mooning. Maybe in the future I'll get it back. Maybe. Awesome. Exactly. PE ratio comes in today. Awesome. Let's go. Good morning from the UK. Good morning from Florida. It's his birthday. Wow. Hope you turn out to have an amazing birthday today. That'll be the best birthday ever. They could go bankrupt today if Noto drops Galileo news and drops another Fortress deal. It's over. We're up 30%. And I think if he has anything in the pipeline, he needs to announce it now, today on the earnings call. He's got to announce anything today they got. The price action is expecting a beat. You could just tell the market, but we still don't know what type of beat. We don't know what the Q4 guidance is going to be. We don't know if they announce tech deals. We don't know anything, you know. I think we can go a lot higher. I mean, we're trading at a price to sales of like 4. Let's retire. Good morning from Holland. Good morning. Yeah, he'll be on all of them. Bloomberg, CNBC, everything. Guys, be sure to smash the like button. Share this video on Stock Twits. This is it. We're getting there. 7 minutes. 7 minutes. This is it. This is it. Yeah, Jim Cramer, he's flip-flops too much. He's mentioned SoFi 20 times. Oh my god, I'm sorry, guys. All right. I'm sorry, guys. We are going straight to the top of the comments. We have to. 7 minutes. I'm going to see what you guys got to say. Here we go. Singapore. A lot of people from Singapore. Jesus. Good morning. Good morning. Good morning. 6 cents. Whew. We get 6 cents, guys. Holy crap. Strap into the rocket. We are going to the moon if we get 6 cents. Holy crap. Let's go. Seattle beats top and bottom. Under the sea, Patrick Starr. More nervous for SMCI. Singapore again. Let's go. Greece, Germany. Buy more at 11. Good amount in it. Good morning from Mars. Malaysia, London, Denmark. 650 in revenue, 650 on members, 50 million in profits, 3 billion in deposits. Let's do it. 9 cents. Come on. Situation. Good morning. Netherlands, Arkansas, Singapore again. What the heck? You guys are all on SoFi. What happens when you hit the cap? I don't even know, man. It's a big, ordeal. We'll have to see. Are you attending the SoFi TGL event? I probably will, honestly. I like golf. I like Tiger Woods. I want to see Tiger Woods play. 8 cents, baby. Taiwan, 9 cents. Philippines, Tokyo. The call is 8 a.m., but these numbers are dropping at 7 a.m. These numbers are coming out. Good morning, Bronx. It was pretty good year over year, but man, they were flat quarter over quarter. We're not going flat quarter over quarter. We're freaking tripling our net income quarter over quarter. Suspense, killing, 1150 for sure. Greece. I couldn't sleep. Yeah, I didn't sleep that well. PayPal and SoFi. Let's go. Netherlands, Cali, Malaysia, Florida, Canada. I'm more nervous than I was for my wedding. Oh my God, your stomach's probably twisted right now. 9 cents. Portugal, Amsterdam. I don't know where that is. EPS 5. Turkey, Japan, Maine, Los Angeles. Good morning. Hi from your mother. That ain't my mother. Troy, Michigan. Good morning. Greece, Knoxville, Austria, Hong Kong, Dallas. Dude, you guys are blowing me away. This is crazy. Singapore, Taiwan, Arkansas, Canada. Man, I can't believe the YouTube channel is going out that deep. That is way past Florida. Hong Kong, 9 cents. Good morning, Hong Kong. Florida, Milton sucked. Yes, it did. I was out for 7 days. Singapore, France, ready sell puts on a dip or calls on the rip. Montreal, Canada, Philippines, EPS 5 cents just out. Come on. All right. We got 4 minutes to go, guys. Taiwan, Sweden, Taiwan, 9 cents. What is that? Czech? I'm not sure. Zek? Good morning from San Francisco, UK, Singapore, Spain, Taiwan. Oh my good. Pfizer just beat up $1. Hey UK, 14, Cali, Sweden. Oh my God, guys. We are about okay. Jesus, guys, you guys are killing me. Okay, holy crap. Oh my goodness. I can't even read all these comments. I'm sorry. All right, guys. 3 minutes to go. This is it. 3 minutes to go. I'll probably I can get the earnings to you probably. My guess is 7:01 at the latest. If I'm a minute behind, yeah, I'm a minute behind. But I can get the earnings to us by 7:01. Oh my God, I gotta lock in. This is it. Oh man, this is it. Trust in management. Trust in management, right? Trust in management. 2 minutes. Here we go. Here we go, guys. All right, I'm gonna bump you guys up to a bigger. Let's see. There we go. I got you guys a bigger chart. Here we go. 2 minutes. 2 minutes. Wow. Here we go, guys. Here we go. This is it. This is it. We have pre-market. We are down 3 cents, 2 cents, flat. 2 minutes to go. 2 minutes to go. Here we go. Here we go, guys. This is it. This is it. Smash the like button. Eat your vitamins. Say your prayers. This is it. 2 minutes. 2 minutes. Man, this 2 minutes is just frozen in time. Holy crap. Are we not frozen? Okay, 1 minute. 1 minute. Here we go. Crash. Nice. Funny. Smash the shorts. Okay, boys and girls. Here we go. 1 minute. I'll get these earnings out to us. About a minute max. 6:59. This is it, guys. This is the stock market. This is it. Here we go. 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 6:59. 6:59. 1 minute. 1 minute. 1 minute. 1 minute. 1 minute. Here we go. Here we go. Come on. Come on. Come on. I'm looking for 660 revenue, 5 cents EPS. I'm looking for 5. 4 is okay. Here we go. 7 o'clock. 7 o'clock. Here we go. Earnings should be dropping any second. Earnings should be dropping any second. Earnings should be dropping. Earnings should be dropping. Hang on, guys. Looking. 7 o'clock. I'm looking for stock Titan. That's where I usually find the stuff the fastest. Okay. Still looking, guys. Some of you guys actually might have it if you got like Bloomberg Terminal or something. $7.01. Remember last earnings, I got it quicker. Let me take a look. Damn it. You got Oh my God, what the hell is happening? I'm looking at some of your guys' comments. Jeez, what the heck? Yeah, some of you guys already got it. Hang on, I just want to read it for myself. Yeah, I seen somebody put, holy crap. I'm looking at, see, hang on. Stock's up a little bit. Come on, man. Come on, man. It was way faster last time. I had it way earlier last time. Come on, man. That's crazy. Hang on, guys. Hang on. Lock in. I can't trust anybody's numbers, guys, until I read the report for myself. You know what I mean? I can't just read out the numbers on the YouTube in case someone, tries to mess with us. Come on, just give me the stock Titan. What the hell is going on? I have to get it from a reliable source. Hang on 1 second, guys. Hang on 1 second. Okay, I'm sorry. I should just went. I got it, guys. Okay, hang on. Here we go. Holy shit. 689 on revenue. 689. Oh my God. 689. Holy shit. Revenue was out of this world. I was at 660. Oh, what the hell? Hang on 1 second. 689. Adjusted EBITDA 186. Diluted EPS 5 cents. Boom. 5 cents. That's it. We beat it. 1 cent EPS. We beat it by a cent. 5 cents. 5 cents EPS. 689 million in revenue. That's awesome. Let me take a look at the guidance real quick. Guidance. Holy crap, guys. They increased. Oh my God. Yes. They increased guidance from the previous quarter was 9 to 10 cents EPS. That's what we were looking at full year, 9 to 10. They jumped it up 2 cents to 11 to 12 cents EPS, guys. So this is the first time this year they went from 7 to 8 to 9 to 10 to 11 to 12. They did a 2 cent EPS guidance raise. And on revenue, their previous guidance was 2.465 billion, which was 19% growth on the high end. They increased it to 2.55 billion, 23% on the high end, guys. I haven't even looked at the stock. I'm gonna look at the stock. I don't even know what. I mean, green. I don't know. What else can you ask for? This is the first time I looked at the stock. Saw the numbers, massively beat my expectations everywhere across the board. Revenue, 30 million beat. My jump, my not 30 million beat. Mine was 15 million beat. They beat mine by 30 million. So ridiculous revenue growth. What was the growth rate? Let me get deeper dive into these numbers. Holy shit. Technology platform is re-accelerating. Technology platform jumped up from 95 million to 102 million. Galileo is back in rhythm a little bit. That is great. Financial services. Oh my God. Financial services, $238 million. That's 238 minus 178 last quarter. Financial services grew $60 million. Oh my God. Lending. Oh my God. Origination 6.3 billion for this quarter. That's a billion over. Oh my God. These guys are back. Dude, come on, dude. This is crazy. Every segment, financial services, ridiculous. Galileo even reaccelerating. Lending way over. Oh my God. All right. If you're looking at last quarter, the Q3 or the Q2, that quarter was not that good. This is holy. All right, I gotta look at some more stuff. Jeez, this is what I wanted to see. Finally. Oh my goodness, we're back. Fuck. How many members did they add? I didn't even look at that yet. Members. Oh my God, they added 756,000. What the fuck? What did I say? I said 680? Oh my God. Dude, somebody's getting squeezed today. I don't give a shit. The stock can say whatever it wants in this pre-market bullshit. I don't give a shit what it says right now. This shit is going up. Oh my God. What the fuck? Bro, the stock is going to move. There's no way. There's no way. There's no way. Come on, guys. Did you see these numbers? You guys are tripping if you think this shit isn't moving. What? Dude, this is our 4 quarters in a row of profitability. This is like perfect execution, perfect timing. Q3 was 645 top end revenue. They came in at, what did they come in at again? I'm lost. Sorry, I was on the wrong page. 645. These guys came in at 690. Guys, listen to me right now. I always talk about on my YouTube channel these quarter over quarter jumps, right? All right, look at this. I always talk about these quarter over quarter jumps for SoFi revenue, quarter over quarter, not year over year. And you can see this was the biggest quarter over quarter jump they ever had in history. Look at this right here. What is this? $63 million jump, right? This is the biggest jump they ever had in company history. Q3 2023 to Q4 2024. Even though this was a great quarter, remember we sold off because, hey, they went transition year, conservative on lending. Look at this, guys. This was the biggest jump in company history. Look at this. Let me get the math right, just so I can get the exact number. I'm not that good at math. 689 minus 597. That's a $92 million jump. And the rate cut had only kicked in like 10 days prior. Guys, do you understand how big this company is about to get like in 2025? They are going to be like huge. I just said I wanted 700 million for Q4. We're literally hitting 700 million now. You know what I'm saying? Like I was like, man, if this company can get to 700 million by Q4, that's awesome. We're already there in Q3. I was predicting 660 million in revenue. These guys coming in at a 90 million jump quarter over quarter, and this was supposed to be the conservative year. Come on, what are we doing right now? Guys, wake up. Look, I mean, this is blowing my expectations. Like from what I saw, and I thought we were gonna be up a little in Q2. I was like, hey, this is a good quarter. This is not bad. Ain't crazy. What? 90 million quarter over quarter revenue jump. Look at the SaaS industry. I can tell you right now, SoFi is growing faster than 95%. When I say these numbers, I'm not lying. They're growing faster than 95% of software as a service industry that gets these 20 times sales multiples because they jump their little revenue up 20, 30, 40 million dollars. Guys, wake the fuck up. I'm telling you right now, everything accelerated. Galileo accelerated. Financial services grew 60 million quarter over quarter. These guys are originating 6.2 billion in freaking lending. What are we doing? God. Dude, this shit is gonna squeeze. There's 180 million shares short. What are they shorting? What are you shorting? You're not shorting shit. God. Come on, guys. What are we doing here? What are we doing here? This is ridiculous. Hang on, let me take a look at some stuff. This is crazy. I mean, any type of sell off is getting bought up. I don't give a shit. If it sells off, that shit is getting bought up. Bro, come on. What are we? We should be the #1 trending. There's no way. Like, come on. I'm so excited. I'm so excited. This is awesome. This is awesome. Man, this is great. This is great. Holy crap. Hang on one second, guys. Hang on one second. Okay. Whew, fuck. God damn. That's what I'm talking about. Hey, it might not be today, but man, them price targets I was throwing around for this week ain't looking that bad right now. Easy. Idiots. Burn them. Zoom. Oh shit. Yeah, guys, see, look, I'm not even paying attention. We just broke no, not the 52-week high, my man. 3-year high. 1170 was the 3-year high. We just smashed through that. Okay? Holy crap. Good morning. Squeeze. There you go. Giddy. I had to track it. Yeah, I can. I'll work on that. Resistance. Yeah, we'll smash that. Awesome. Better than Christmas. Add. Let's go. Let's go. Man. Man, we're looking good. They're doing so good because they have so many high quality members that they need better services than banking, and these services are just helping them, grow everything, everything, like literally every segment. I mean, you got mortgages. Guys, I have a business, and I'm telling you, I'm meeting with some of my clients that are like literally early 30s, and I've met with like I think two doctors now, two doctors, and they say, "Yeah, I got all my student loans with SoFi." You think these doctors aren't paying back their student loans with SoFi, dude? They got the highest quality student loan members ever, and that's going to be a business that's booming again. Mortgages are picking up because of the Wyndham Capital. Their AUM is skyrocketing. The ARC deal they made, with their platform. I mean, the the IPO access that they got, that's going to give them massive fee bonuses. People jumping on their lending platform with the Fortress deal, Light Capital. It just doesn't stop. Like, I'm telling you, they have so many different segments of revenue that they can go after, guys. The personal loans are accelerating. It's less risky. I mean, lower interest rate than a credit card. Everyone's going to go with it that, has higher credit card debt, especially these higher earners. That's exactly what SoFi wants. Like they are killing it. Like $90 million jump. Are we looking at like $200 million jumps for 2025? Like what is going on here? Chia Pet will upgrade. He will upgrade 50 cents or a dollar. I'm telling you, the Chia Pet upgrade is coming. He wants to stick to his ego, but he doesn't want to look like a complete super ass. You know what I mean? So I expect a 50-cent upgrade, at least a dollar. Like this dude has to wake up and smell the roses. Chia Pet will be upgrading. There's no way he'll reiterate. He's not stupid. He's gonna look like an idiot if he reiterates. Finally, wow, burn him. It's so easy to use, guys. I try to honestly here, just listen to this story. I try to do like a little bonus for another institution. I wasn't gonna stick with them, but I just tried to do the bonus, like a deposit bonus to get like a $500 bonus or whatever. And I did it. Man, it was the worst experience ever. Like this check I cashed bounced. It took them like 4 days to let me know. A week later, they sent me a piece of mail saying the check didn't go through for something because of my business name. And there's a guy calling me every couple of days, like some banker. It's just like, man, these guys are living in the stone age. Some of these legacy banks. I'll tell you what bank it was. It was Fifth Third. They're just too old school. This shit sucks. My price target now off of this earnings, holy crap. I mean, right now, fair value with this earnings that they put out, I mean, this stock should be worth $19. Honestly, guys, like this stock should be worth $19 all day. They're 4 quarters in a row of gap profitability. They just hit the highest gap profitability ever. They just went from, this is a conservative year, remember, and they're expecting this is the transition year, conservative. They're expecting 23% growth. They'll probably come out at 24. What? Conservative? 24% growth? What is next year going to be? There you go. Guys, this is going to get smashed, okay? Just let you know. This shit is going to get smashed. I'm gonna take some look at these numbers a little more. Okay, let me look a little further in. Damn, these guys are killing it, man. These guys are killing it. Let me look. I want to look at stock-based compensation real quick. Okay, let's look at their balance sheet. Oh my God. No way. No way. No way. Okay. Wow. Wow. Damn. 23. Man, their cash stayed exactly the same. And their liabilities went down and their debt stayed pretty much like neck and neck. So their balance sheet looks good too off of that. They didn't have any counting, boosts or anything. Stock-based compensation. Wow. Pretty much $2 million higher than last quarter. 63 million, guys. You can't beat that. Like literally the exact same, stock-based compensation. $2 million plus. Crazy. Appreciate it. Man, this was awesome. I'm very excited. Almost 6 million, almost 6 cents, somebody said. Yeah, I haven't even looked into that exact number. So we almost pulled 6. Wow. Oh, an amazing guidance increase, guys. That's what I'm trying to tell you. Like, you got to look closer at the numbers. Like, look at this, guys. When they started out, off going off to that 2024, they put out a guidance of 14 to 16% growth, which we knew they were going to beat that. But look, they ramped it up to 15 to 17% growth. And then they ramped it up even higher to 17 to 19% growth. So they'll likely come in at like 21, 22%, this year. Wait, I'm looking at the wrong one. I'm sorry. Hang on. That was the wrong one. Hang on. Sorry. That was wrong. I was like, man, something's wrong. My number's wrong. Here we go. Okay. That was the previous quarter. Okay. They went from 14 to 16 to 17 to 19 to 22 to 23. I was like, man, why did I just back off from my 24%? Yeah. 24. So if you're going from 14% growth on your low end to maybe 24% if they beat on their high end, that is their conservative year. Conservative. 2 quarters of just, okay, we're going to back off. I'm telling you guys, my numbers I put out for next year, I think they're going to hit. I honestly think my numbers are going to hit for next year, where I put up, I think this company's going to grow 35% next year. And if this company grows 35%, this is going to be a monster. A monster. I'm excited. These are some really good numbers. Like compared to going back to that last quarter I had to look at, where I was trying to be excited. Man, this is a totally different story. That's all right. We got Anthony Noto on the call soon. He could say something really good. He could announce some deals with Galileo. I mean, we see revenue. Let me show you real quick revenue. Okay, hang on one second. Okay, here we go. Take a look, guys. Take a look. I was telling you, look right here. These numbers are Galileo revenue. You see this? So this is Q1. Oh, sorry. This is Q4, 96. They went down Q1. Q2, they had $1 million. And then look, see, it's accelerating finally. $7 million quarter over quarter. Just like they said it was, okay? So you can see this is the technology platform acceleration. We went through 4 quarters of like hell. This thing didn't do anything. So this is exactly what you want to see heading into Q4, okay? Awesome. We cannot complain with that, guys. We cannot complain with that. So Galileo is back. That is good. Who is averaging up? Oh man, it honestly depends on what Anthony Noto says. It's coming, guys. It's coming. It's coming. It's coming. It's kicking in. It's kicking in. Yes. Gosh, I don't even want to know how big lending could get if that happens. Me too. I think I'm quality. Yeah, so we're looking at like 14 cents potentially coming in. I think Q4, guys. If this was, oh man, why am I? Oh, it's starting to happen again. I'm thinking about Q4. Oh man. Oh man. These guys might be going for the $100 million profit, guys. They might be going for the $100 million profit already. This early in the game, with this type of growth, this type of member ads, 30% growth with freaking 100 million profit on the bottom line, adding 1 million members to your platform. This company is about to get nasty really quickly, guys. Oh shit, I'm trying to think. Is the earnings call at 8 or 7:30? I think it's at 7:30 or 8. Can somebody confirm because my brain is still really foggy. Is the earnings call 7:30 or 8 Eastern time? Is it in 4 minutes or is it in 34 minutes? Because I registered for their thing and it's not popping up yet. So I'm guessing 8 o'clock. Yeah, I was about to say I'm already registered and it didn't pop up. So not 20 minutes, 33. Yeah, we got 33 minutes to go, guys. Awesome. I'm already registered for the call, so the call will be on here. Look at this guy. Stop glazing. You're funny. All right. So I'll ask you guys some questions. What did you like most in this earnings call? What did you like the most? Um, I can honestly say that makes me feel the most confident is I like that their overall revenue, every segment grew so much. 90 million quarter over quarter. That is what I like. You know why? The bigger your revenue grows in your business, the opportunity you have for bottom line profitability whenever you want it. So you need to grow your top line to, 2, 3 billion in revenue a quarter. So I just like that their revenue is so strong right now. It gives them net income flexibility because they're growing that shit $90 million. So that's what I like. That's what I personally like the most. I like their flat out revenue. I was pulling for 660. I said anything over 660, we're Gucci. We're great. 90 million, 690? Come on. Come on. Guys, this is what I was anticipating. My last couple of videos getting closer to this earnings, I was like, man, this is the one. This is what they need for 4 quarters in a row profitability, guys. This is it. Yep, diversity guy. Every segment is back. Galileo's back. Every segment is back. There is a high probability that that is going to happen off these numbers. These numbers were crisp. This is an A plus 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 quarter. This was a flawless quarter. They said, "Hey, we're going to use our platform, our technology. We're going to make every number perfect this quarter. Members, lending, financial services, Galileo, stock-based compensation, everything, net income, accelerating growth next year for the guidance." What? This was a triple A quarter. This is ridiculous. I'm going to be sleeping so good for the next 3 months heading into Q4. Exactly, guys. I this is it, man. This is what I live for. This is it. This guy said 750 members. I think when we get the 1 million members per quarter to the moon, baby. Yeah, it looks like it's coming with TGL, NFL, and NBA. Anthony Noda loves sports, and hey, people with sports, they like, online banking, it looks like. So SoFi, as of right now, is at the halfway point of being S&P 500 inclusion, okay? They got their 4 quarters profitability in a row. They're a high-tech growth company. They want to put in high growth companies into the S&P 500. But we need to have an $18 stock because the minimum market cap requirements have, the bar has been raised dramatically. We need an $18 stock and probably got to maintain $18 for about a quarter, 90 days. So once the stock hits 18, it is fully eligible. Everything eligible across the board. We need to be at $18. Just so you guys know, market cap has been jumped up to 18 billion. It used to be about 13 billion like a year ago or something like that. It's been raised dramatically. Okay. So just understand that we need to be at $18. And I think the stock's going to get $10 in premium on the S&P 500 ad. So we need to be over 18. You get your $10 in premium, 28. Boom. Okay. So Noto's hunting for 18. He knows he has to get to 18 to get that massive institutional buying. He knows 18 needs to come. Accumulating. Oh my goodness. Gorgeous. 8 o'clock, 29 minutes. These guys have nothing. There's nothing left. It's over. They have nothing. We already have analysts starting to flip to like $14 price targets. We already had analysts at $12 price. You might see like a $16 price target get thrown around pretty soon. These guys have nothing. Probably in the morning, maybe 9:30 throughout the day. Even this week, I could see the stock going up higher. So when we hit over $18, yeah, we're looking good, guys. I appreciate it. I appreciate it so much, man. Damn, making some money. That's what I like to see. This is gonna be a great company. I'm telling you, like, don't sell it all at 20. That's all I can say. Sofi. Yeah, it's been a rough ride. I understand. Solid. I think PayPal's solid. I wouldn't put my money in PayPal over SoFi right now. There's no way. Like that this how fast this company is growing, how much market share they're stealing. I just couldn't. I think, if you had like, let's say you were like 100% SoFi. I mean, you could put like 15% in PayPal, diversify a little more, but there's no chance I would do like a 50-50 split with PayPal at all. Like there's no way. But PayPal's good. It's just been around so, a long, long time. They don't really have anything, to be honest. I mean, the stock can do whatever it wants in this pre-market, but you're gonna see institutional buys come in and pound these guys pretty soon. Maybe. I mean, they have so much market. Some people just refer people too without marketing. And people just refer people uh to each other and that's free advertising. So some of these high quality doctors say, hey, I just finished med school. I did my loans with SoFi. The rates are good. You should do it. And then boom, that doctor does it. Then that doctor does it. And then boom, those doctors make a lot of money. And then they get a house. And then SoFi gets the mortgage. It's just it's awesome, man. Yeah, I appreciate it. I want to look at some of the headlines. Let's read what the headlines are saying on SoFi. Okay, let's see what these guys are saying. SoFi Technologies Q3 net $60.7 million. Tangible book value grew $236 million. Q3 net interest income $431 million. Total members reached 9.4 million. Total member adds 7.5. Raises revenue to 2.535 to 2.55 billion. 2.45 billion previous estimate. Raised EPS to 11 to 12 cents. Sees adjusted EBITDA 605 to 615 million. Reports 5 cents EPS to consensus 4 cents. Man, you can't. That's it, guys. That was the perfect headlines you could ask for. You know what I'm saying? That was amazing headlines. Like, you can't really ask for anything better than that. Wow. All right, guys. We have 25 minutes to the call. I mean, I can't wait to hear Anthony Noto on this call, guys. Like, I am so excited. What if they announce something? There's a possibility they may announce something. There is definitely a possibility. Um, we're up a little bit. I mean, we smashed through 52-week highs. The 1170 we smashed, just pulled back a little bit. I don't know. I honestly think we're going a lot higher, to be honest with you. A lot higher. That is crazy. Man. Yeah, Anthony Noto he's not gonna fumble this bag on this call. He's not gonna fumble the bag. I'm telling you guys, Anthony Noto, he's gonna seal the deal here. This is where he seals it. He's gonna seal the deal here. I'm telling you, he's not gonna give them anything. Anthony Noto's go-to. Guys, remember pre-market action? I mean, it really doesn't mean anything, but you saw the initial reaction was the pop. So you can see the stock sell off a little bit. Call hasn't even started. Numbers are great. This is where they try to like clean out retail investors trading on Robinhood that are like 24 access to their trading, and they just try to wipe them all out with just fake price action. This is where they try to like clean out retail, steal some shares, put them away for the long term. So that's what you usually see. Did it stop at 11.99? I didn't see the high. I was too busy. I didn't know it I didn't know it hit 11. See what I'm saying? The stock is just traded to the penny right now on algos. Like they have to just have it slow down at the penny. Like every 10.99 last week, 11.99 in the pre-market, everything is down to the penny. Man, this was a great call, guys. We should be up a lot higher. I think we will be up a lot higher. Yeah, 11.99. That is wild, but it could be, that could be the retail clean out, the profit taker clean out. I mean, yeah, this man. Who wants to drop a guess? See what I'm saying? I didn't. Somebody said 11.87. Who wants to guess the volume today? Like, what is the volume going to be today? My guess, I'm gonna go with 200 million on the volume. I'm gonna go 200 million on the volume. You lost your chance, douchebag. Bye bye. Oh, damn. Hmm. Whoa. 10? Are you out of your mind? PayPal's getting smoked? Are you serious? Holy shit. What happened to PayPal? What happened to them? Damn, that sucks. Let's see. Crypto's pumping right now. Crypto's pumping up really high. Um, Holy crap. That is crazy. Yeah, the high. Yeah, I don't know. I don't know if the high was 7.99 or 11.99. Sorry. It's a possibility. Yeah, this stock is up high. Wait for my Google 190 calls. Wow, that sucks. I don't know. We were at 70 million volume yesterday. I don't think I don't know. I don't think that's not enough. Like we were at 70 million last quarter or yesterday, 70 million. That just doesn't seem like enough. I don't think so. I think that's a reason for institutions to jump into SoFi because of the earnings report that we produce, guys. I think this is good. PayPal flopping right here. PayPal's a massive company. They're like $80 billion or something like that. This is great news for SoFi. The high today, let's see. We were at 11.20. I think we're gonna break over like I think we'll break over I think we can break over 12.50 today. It's a possibility. That's just today alone. All right, guys, we got 17 minutes till earnings call. 17 minutes. Um I want to see what people are saying. I want to hear what other people are saying about this call. Damn, man, this is a good ass quarter. What was the revenue growth? That revenue growth had to have been like, man, 27% year over year. Man, this is they are. I can't believe they're getting 600 and or 700 and whatever members they got. That's crazy. Wow. And they beat their revenue estimate by 8.6%. Wow. Yeah, I don't know. I think we're looking good, man. We gotta just listen. We need Noto. We just need Noto to come save the day. We need Noto right now. This is where we need Noto. This was the best quarter in company history. Q4 2023 was that blowout. This smoked that earnings report. This was an A plus plus like earnings. Like this was crazy across the board. Like every segment had a new high. Financial services, Galileo, lending, members, everything hit a high, all-time high. Revenue growth, net income, everything. I mean, this was an amazing quarter. Like amazing. So triple A. I'd say triple A plus plus plus. Strongest quarter ever, yes. Yeah, I think Q4 could be the Galileo ramp up, guys. I think that's where Galileo like possibly could see the revenue jump to like 120 million, from 103 quarter over quarter. That'd be like a 17 million jump. We could see something crazy. And then, that segment could finally start taking off. Solid. Yeah, guys, this is I don't know. I don't know what they're shorting, to be honest. I don't think it's gonna last. The market is getting a little the market's getting a little weird right now. I mean, you have everything crypto exploding. You got Coinbase, Riot, Hut 8, CleanSpark, MicroStrategy, and Bitfarms. Everything's going up for crypto. And then you got Trump Media and Technology, DJT, is up 18%. That stock was at $12 last month. It just went from 12 to 56. That is crazy. 12 to 56 on Trump Media. And you got to think it did go from like 70 to 12. So that's the risk on stocks like that. 70 to 12 is pretty scary. But yeah, we're just looking, and the market's looking a little weird right now. It's looking like a lot of stuff squeezing crypto, and there's like eight crypto stocks squeezing right now. So it doesn't matter what you buy. You can buy any single one of them and you're going to be making money. But I think SoFi is just fundamentally strong right now. I think the fair value is like $19, and I think we're going to get there. I don't think the shorts really have anything, to be honest. Man. Well, guys, 11 minutes till Noto. 11 minutes till Noto comes on. 11 minutes. I'm excited to hear what he has to say. Hopefully it's a great call. Man. This is it, boys. This is it. Oh, hey, there's a Barron's article out right now. And it says SoFi delivers another strong earnings report. CEO says 2025 looks bright. That's not even the Q4. That's 2025. He said 2025 looks bright on a Barron's report. Oh my God. Damn. This is awesome. 2025 looks bright. Can't beat that, man. We know what's coming. My God. I'm so excited, guys. Dude, we're going to be at like, oh my God, I can't even think about how big this company is going to get in 2025. I think they're going to be clearing like $1 billion quarterly revenue pretty soon. This thing's going to become a monster. So you probably just hopped on the channel. I went over this, but that's 50% of what they need to do. They're eligible for S&P 500 on profitability, but they have to become an $18 stock. The stock has to go over $18 to get into the S&P 500. So, yeah, it's pretty good. Almost there. The call is starting in 9 minutes at 8 o'clock, 8 Eastern. Maybe the cap call investors are going to load up. Maybe the cap call boys are coming in and taking it straight to the 1450. Eight minutes. I'm ready for the call, guys. I'm ready for the call. Hey, I really, really appreciate it. I think we're going higher this week. Man. Oh my goodness, this was a great call. Oh my God. Well, I don't know if you can trust pre-market action at this point. Yep. EPS is just getting started, guys. I mean, already clipping 5 cents. I mean, it's just getting started. It's early. It's so early. They beat their guidance. I'm sure there's gonna be profit taking. You could see like stock hit like 1454 and then come back down to like 12, for 15-20% pullback, something like that. Yeah. There'd probably be a little selling. I don't know. Yeah, screw this pre-market. This pre-market don't mean anything. This is all fake algos, BS volume, shorts dumping, rebuying, selling, covering. It's all BS. You got to look at the the report and just know what the report said. I mean, this was a big one. This was a really, really strong quarter. 6 minutes. 6 minutes till the call. What did PayPal say? PayPal growth rate slows across regions and total payment volume. Oh, you do not want to hear that. Growth rate slows across regions and total payment volume. Come on, look at the headlines on SoFi. We should be so much higher right now. This is crazy. They are trying this stock right now. I mean, come on. Company recorded $174 million in light capital free fee-based revenue, reinforcing strength of increased mix of higher return on equity revenue. Oh my God, that's exactly what I want to hear. That's exactly what I want to hear. 176 million light-based capital. Gosh. 4 minutes. He's not going to be on CNBC till like 9:30, 10 o'clock, 10 a.m. I'm not sure. I just want to hear like another, if they can announce another Fortress deal, oh my God, I'll send the stock mooning. There's got to be another fortress deal in there, man. There has to be. Y'all be sure to subscribe to the channel. I'm going to be knocking out a lot of videos this next Q4, covering how big this bad boy is going to be. So be sure to subscribe to the channel. Let's try and get the channel over 20,000 subscribers. This is it, guys. This is going to be a big company very, very soon. So smash the like button, subscribe. This is it. The tide is finally changing. Man, that 5 cents was money. I knew. I just had that feeling. I was like, man, it's gonna be 5 cents. I just know it. And if you watch my video, I said 5 cents. I didn't say 7, 8. I said 5 cents, and I said revenue 660. I was not expecting 690. Come on. Damn, this was a good call. Oh man. I mean, I know the stock's at 1150, but I mean the 1 year high, the 52-week high still, it was like 1136. So we're kind of clearing the 52-week high in pre-market. That's a good sign. We already blew past the 3 year high of 1170. I think we're gonna smash that soon. As long as I think the big whales are actually waiting for the call because they just want to make sure Anthony Noto doesn't say transition, slow down, pull back. You know what I mean? That's what the market is waiting for. But even though he said in that article 2025 looks bright, I think they want to hear it from him himself. Man, there's gonna be a super whale to come in. I'm telling you, there's gonna be a super whale that's gonna buy 50 million shares or something crazy, 25, 50 million, like a super whale just come in and just get this shit moving like $2 out of nowhere. All right, guys. Call should be starting pretty soon. We're gonna wait on that. Let me know if the call starts and then I'll blast it because it's got this copyrighted music on it every time they play. I got copyrighted before on the music they play. Oh, look at that. Bouncing off the 1150. You see, guys, just look. Everything is 11.99. Algos. 11.49. Algos. Last Friday 10.9. It's all bullshit. This penny bullshit on $1 or 50 cents. That's all these shorts try to do is put all their money in together and they get the flushes at the dollar penny or the mid-tier 50 cent. That's all they try to do every single week. Here we go. Oh, I didn't. Let me refresh. I'm gonna refresh it.
Good morning, all. Good afternoon. This time, I would like to welcome everyone to the Sofi Technologies Q3 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, that would be star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's third quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Good morning. Thanks for joining us today. I'm thrilled to share our results for Q3, which was the strongest quarter in our history. I want to thank our members and clients for continuing to put their trust in Sofi, and to thank our team for their absolute grit delivering another great quarter. Our results reflect far more than just 90 days of work. They show how Sofi is consistently achieving durable growth, how our innovation and brand building are attracting more members and clients to our platform than ever before, and how we are delivering strong and improving returns. I'll touch on these three topics before handing it over to Chris, who will share our financial and operating results. First, on Sofi's performance as a durable growth company. Q3 was another record quarter for Sofi. We built on the strong momentum from the first half of 2024, putting us on pace to significantly exceed our 2024 plan and firmly on track toward the three-year outlook we shared at the end of last year. Here are some highlights. Adjusted net revenue reached a record of $689 million in the quarter, a year-over-year acceleration in growth to 30% versus 22% in Q2. For the first time, financial services makes up more than a third of our total revenue. The segment recorded $238 million of revenue in Q3, up 102% from the prior year. I could not be prouder of how we've scaled this segment over the past 5 years since launching these products through a tumultuous and unpredictable environment to now be a $1 billion annualized revenue business, growing over 100% with strong and improving profitability. And frankly, it's still day one. Our tech platform grew to nearly $103 million in net revenue, up 14% from the prior year. We continue to see a strong pipeline of potential partners that are striving to modernize their platforms. Combined, our non-lending segments grew 64% year over year and drove the company's overall growth of 30%. And now they make up a record 49% of total revenue, up from 39% a year ago, driving an important diversification of our business. We also recorded tremendous growth in key revenue drivers, members, products, as well as revenue per product in the quarter. We added 756,000 new members in Q3. That's up 35% year over year to a total of 9.4 million members. We grew products in the quarter by over 1 million to 13.7 million products. That's up 31% year over year, or 37% when excluding digital asset accounts related to our transfer of crypto services in 2023. The financial services segment drove 964,000 of those new products. Importantly, revenue per product was $81, up 52% from a $53 a year ago. We believe there remains substantial upside in both product growth and monetization. Our one-stop shop continues to attract great cross-buying behavior by our members. In fact, 32% of new products were opened by existing Sofi members, and 20% of our new members open a second product in their first 30 days. This is the power of the flywheel we have developed. In our tech platform, we reached over 160 million total accounts. That's up 17% year over year. Overall, we're making incredible progress in our shift towards more fee-based, capital-light, and lower-risk revenue sources. Combined, fee-based revenue made up $174 million, or a quarter of our adjusted net revenue in Q3. This revenue grew by 65% year over year. On an annualized basis, that's nearly $700 million in revenue. This progress was driven by a record quarter in our loan platform business, which totaled $56 million in fee-based revenue and is up more than 5x year over year, as well as strong growth in interchange, which is up 2x year over year. Chris will share more details on these areas in a few moments. On top of all of this work to diversify our revenue base to capital-light, high return on equity, and fee-based revenue, we also grew our lending segment in Q3. We seized on the improving rate environment in the quarter, our improving credit trends, and strong performance across all lending products to achieve a record $6.3 billion in loan volume and $392 million in adjusted net revenue, up 14% year over year. Looking back at the progress we've made over the past several years, it's fair to say that SoFi is battle-tested, given the scale, profitability, and growth we have recorded for the total company in 2024, with our largest and most profitable business lending barely growing. It should now be crystal clear that SoFi can drive sustained growth across the cycle. We've achieved 17 of 19 quarters of record revenue through a recession, a pandemic, a 150 basis point rate drop, damage to our largest and most profitable business, student loan refinance, only to face a 500 basis point increase in rates and the collapse of venerable financial institutions in our neighborhood. The innovations we have driven to scale our non-lending revenue, which are capital light and high ROE, have enabled us to grow our total revenue by more than 20% year over year for 17 consecutive quarters, as well as grow both our members and products by 35% or more year over year, excluding digital asset accounts transferred in 2023. Our performance in the hard times is what gives me the strong confidence in our future. Today, we face fewer headwinds than any point in our history. We're heading into 2025 with the most favorable conditions of the last 7 years, with declining rates and a stable economy. With the most diverse business we've ever had, with more members in our ecosystem and more products that serve their needs than ever before. This brings me to my second topic, the innovation and brand building that drive our durable growth. The market for consumer financial services is massive and historically poorly served. A Mintel report found that just this year, 1 in 5 U.S. adults have been in the market for a new savings account. A similar number are looking for new credit cards. Those markets, not to mention those looking for new investment accounts, new checking accounts, new personal loans, new mortgages, and buy now, pay later, all grew year over year. Meeting all of a person's financial needs in one place with world-class products delivered seamlessly and digitally gives us a massive advantage. This is why you'll often hear me say, it's a matter of when, not if, we become a top 10 financial institution. To do so, it's absolutely critical that we build the unaided brand awareness to become a trusted household brand name. The awareness we generate for SoFi is highly effective at getting people to try a product. After becoming a member, they cross-buy into another product, then another. They recommend SoFi to others. This flywheel that we've created drives acquisition costs down over time and reliably generates profits that we can invest in new product innovations to serve even more of our members' needs. Our accomplishments in Q3 demonstrate the power of this virtuous cycle. First, we continue to establish SoFi as a trusted household name. We ended Q3 with our highest average unaided brand awareness of all time, up nearly 40% year over year to 7%. Our highly effective marketing engine continues to reach and engage new audiences. For example, Q3 saw the kickoff of the new NFL season at the award-winning SoFi Stadium. We unveiled a new brand campaign with LA Chargers quarterback Justin Herbert, inspiring people to reach their most important financial ambitions. We also launched new partnerships with Los Angeles Sparks forward Cameron Brink and tennis champion Venus Williams. And coming in January, the TGL presented by SoFi, a new tech-infused arena golf league with an exciting match play format across teams of top PGA Tour golfers like Tiger Woods, Rory McIlroy, Wyndham Clark, Xander Schauffele, and Justin Thomas, just to name a few. Second, we continue to innovate so people find unique value when they use our products, starting with our financial services segment. In SoFi Invest, we've seen strong engagement driven by new alternative assets, mutual funds, and money market funds we've rolled out over the past year. Overall, we're providing Main Street investors access to unique investment products historically reserved for the ultra-wealthy, like interval funds, private credit, private real estate, and private venture. We also launched our new directed share program, which offers a modern and streamlined approach to equity programs for companies looking to raise capital through IPOs. And we are expanding our award-winning robo offering later this year. Importantly, we are building the Invest business cost-effectively by appealing to existing members. 70% of signups are existing SoFi members. In SoFi Money, we reached record highs in accounts, total deposits, and direct deposit members. We grew member deposits by nearly $2.4 billion, and annualized debit spend reached $10.3 billion in Q3. We will soon improve our self-serve wire transfers, which, similar to introducing Zelle, will further expand members' money movement options. In our member team, we're beta testing a new cash coach product that will analyze members' cash across all of their financial products at SoFi and beyond, and offer various ways to optimize their cash. Whether it's paying down expensive debt, setting up an emergency savings fund, getting more yield on their savings, or making investments in a diversified portfolio that is appropriate for their goals. We're also on track to launch improvements to SoFi Plus, our premium membership tier, and are beta testing a new fee-based subscription option in the coming months. Over time, SoFi Plus will increasingly show the magic of our strategy, deliver incremental and unmatched value across our portfolio of products. In credit cards, we officially launched the Everyday Cash Rewards and the Essential Credit Cards, enabling SoFi to serve more people's spending and borrowing needs, whether it's helping them earn rewards or building their credit. In our loan platform business, what started as a decline monetization funnel has now evolved into an integrated loan platform experience, which now offers just-in-time lending. In Q3, the loan platform business grew 5x year over year, mainly driven by record personal loan volume. We expect this business to continue to grow as we shift towards even more fee-based, capital-light, and lower-risk sources of revenue. We also signed our first 2 direct insurance carriers for SoFi Protect, complementing our comprehensive financial services offering we've built over the last 5 years. Turning to our lending segment. In personal loans, our innovation has helped generate a record $4.9 billion in volume, up 26% year over year, including $1 billion originated on behalf of third parties for our loan platform business. In home loans, we grew total home loan volume 38% year over year to $490 million. Home equity loan volume was up 44% from the prior quarter as rates began to decline. Home purchase and refinancing volumes grew 23% from the prior year period. In fact, home refinancing volume was the highest we've seen since the second quarter of 2022. And finally, in our tech platform, we signed several new partnerships, including processing deals with 2 chartered banks of Mexico and a deployment of Galileo's Cyberbank Core for SoFi's new commercial payment services sponsor bank program. We launched additional fraud prevention solutions, the Galileo Instant Verification Engine, which we call GIVE, as well as Transaction Risk G-Score, both of which help clients enhance their security and operational efficiency. Our new secured credit with dynamic funding offering promotes greater financial inclusion and enables clients to help their customers build stronger credit. And lastly, we launched programs with clients signed in prior quarters spanning cross-border payments, global payouts, financial literacy, and scalable payment solutions. On top of this relentless focus on innovation and brand building, we built our business to deliver strong and reliable returns well into the future. We achieved record profitability in Q3. GAAP net income reached nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year. EBITDA grew 90% from the prior year to a record of $186 million. All 3 of our operating segments achieved record contribution profit in the quarter. We continue to improve credit performance in Q3 and are firmly within the life of loan guidance we've previously provided. As we've shared in our last call, delinquencies peaked in March of 2024. Since then, we've continued to see improvements quarter over quarter. Cumulative fair value adjustments, along with delinquencies on an absolute and percentage basis, all performed better in Q3. With all the innovations we've made across marketing, originations, and servicing, buyers continue to see compelling opportunities in SoFi's loan portfolio. Loan sales reached almost $1.3 billion in total this quarter and nearly $5 billion in the last 12 months. And finally, with our strong balance sheet, we are well capitalized heading into an improving rate environment. Our total capital ratio is 16.3%, well above regulatory minimums. In Q3, tangible book value increased $236 million to a total of $4.4 billion. We look forward to building on this momentum and delivering continued returns heading into the new year. In closing, I couldn't be more proud of what we've accomplished, not just for Q3, but for delivering a steady and consistent record of durable growth, incredible brand building and product innovation that help our members and clients, and strong improving returns for our shareholders. The future is bright, and I am fired up for what's in store. With that, I'll hand it over to Chris.
Thanks, Anthony. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2024 versus the third quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. The record results we achieved across all three segments this quarter are a testament of our continued execution, our durable growth in members, products, and clients, and our diversification toward capital-light, fee-based revenue with increased returns. For the quarter, we delivered record adjusted net revenue of $689 million, with growth accelerating to 30% year-over-year, up from 22% last quarter. Adjusted EBITDA was $186 million at a 27% margin. This represents nearly 9 points of year-over-year margin improvement, demonstrating significant operating leverage across all of our functions, with expense margins decreasing year-over-year. Importantly, sales and marketing continues to decline as a percentage of adjusted net revenue, decreasing by 4 points year-over-year. We delivered our fourth consecutive quarter of GAAP profitability, with GAAP net income reaching nearly $61 million, a $327 million improvement year-over-year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year period. We generated GAAP EPS at 5 cents per share in the quarter. On a trailing 12-month basis, we delivered $214 million of GAAP net income, and when looking at the sum of our reported EPS over the past 4 quarters, we generated about 11 cents per share. Now on to the segment level performance, where we saw record revenue and contribution profit across all 3 operating segments. Starting with financial services, we achieved $238 million in net revenue, up more than 2x year-over-year. We reached nearly 11.8 million products in the quarter, up 33% year-over-year, or 40% when excluding crypto accounts. We continue to improve monetization across all products, with annualized revenue per product of $81, up 52% year-over-year versus $53 in the prior year quarter. This growth was driven by higher deposits and member spending in SoFi Money and significant expansion of our loan platform business, which I'll describe in a moment. Both of these businesses achieved all-time records for revenue in Q3. We also benefited from new monetizable features in SoFi Invest and saw robust growth in credit card spend. We see significant opportunity for growth in these businesses, as well as SMB and Protect, which are all under monetized today. Net interest income of $154 million increased 66% year-over-year, which was primarily driven by growth in consumer deposits. Non-interest income grew 235% to $84 million in the quarter, which represents nearly $340 million in annualized revenue. The key driver of non-interest income growth this quarter was our loan platform business, where we refer pre-qualified borrowers to origination partners and originate loans on behalf of third parties. Here's how our loan platform business works. With our best-in-class product, highly effective marketing engine, and network of respected buyers like Fortress, with whom we announced a $2 billion loan platform business agreement earlier this month, we can efficiently match the demand of members shopping for loans with the demand for high-quality loans in the capital markets. When a member takes out a loan, they gain all of the benefits of becoming a SoFi member, along with easy access to other products in our one-stop shop, even though we originated the loan on someone else's behalf. This enables SoFi to serve more potential members while also further diversifying toward less capital-intensive and more fee-based sources of revenue. In Q3, we generated $56 million in loan platform fees, driven by $1 billion of personal loans originated on behalf of third parties, as well as referrals. We also generated $5.5 million in servicing cash flows, which is recorded in our lending segment. Our loan platform business in total added $61 million to our adjusted net revenue. In addition to our loan platform revenue, we continue to see healthy growth in interchange, up 211% year-over-year, as a result of $12 billion in total annualized spend in the quarter across money and credit cards. Overall, contribution profit for our financial services segment in the quarter was a record at nearly $100 million at a 42% margin, even as we continue to invest in innovation, acquisition costs that require a payback period, and new opportunities to rapidly grow this operating segment with attractive returns. Shifting to our tech platform segment, where we delivered record net revenue of nearly $103 million in the quarter, up 14% year over year and 7% sequentially. Revenue growth was driven by strong contribution from new clients, as well as growth in Latin America, consumer brands in the US, and clients with innovative use cases like earned wage access and money movement. Galileo accounts grew 17% year over year to $160 million. The segment delivered a record contribution profit of $33 million, representing a 32% margin. We've discussed before how the pipeline spans banks, brands, and fintechs across consumer and B2B, which offer larger and more durable revenue. The pipeline is in a stronger spot than it's ever been, and the investments made in this segment have greatly expanded the market opportunity. Recent wins and pipeline strength are early, but telling signs that the strategy is working. Moving on to lending, we achieved record adjusted net revenue of $392 million, with a record of $239 million of contribution profit at a 61% adjusted margin. These results were driven by 19% year-over-year growth in net interest income, while adjusted non-interest income decreased by 2% year-over-year. Growth in net interest income was driven by a 35% year-over-year increase in average interest earning assets, slightly offset by a 44 basis point year-over-year decrease in average yields. This resulted in an average net interest margin of 5.6% for the quarter. In terms of non-interest income, Q3 originations grew 23% year-over-year to over $6.3 billion and were driven by a record quarter in personal loan originations, which grew 26% year-over-year and 17% sequentially to $4.9 billion, with $1 billion originated on behalf of third parties for our loan platform business. Our student loans business saw origination volume grow 3% year-over-year and 28% sequentially to $944 million, our best quarter since Q1 2022. Home loans volume grew by 38% year-over-year and 17% sequentially to $490 million, our best quarter since 2021. In the third quarter, we sold portions of our personal loan, home loan, and senior secured loan portfolios totaling $1.3 billion. In terms of personal loan sales, we closed approximately $375 million of loans in whole loan form at an execution of 105.9%. These had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $504 million of home loan sales were sold at a blended execution of 102.6%. Additionally, we sold $81 million of late-stage delinquent personal loans in the quarter. As we've noted in the past, we typically have not sold delinquent loans until such a time that they are charged off. However, we have been able to generate positive incremental value over time in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we sold $312 million of senior secured loans at a par execution. In addition, one of our large senior secured loans with $594 million of principal outstanding was prepaid and refinanced by the borrower and is no longer on the balance sheet. Net, inclusive of new issuance in period, our secured loan balance decreased by more than $750 million sequentially. These transactions demonstrate clear market support for the marks on these loans, with $312 million of our senior secured loans sold at our marked value and another $594 million of senior secured loans prepaid so the borrower could refinance with another bank at more attractive rates. Turning to the profile of our borrower and the overall credit performance. Our personal loan borrower's weighted average income is $164,000, with a weighted average FICO score of 746. Our student loan borrowers' weighted average income is $135,000 with a weighted average FICO score of 765. After seeing credit trends peak in Q1, we have seen continued improvement in personal loans. Our on-balance sheet 90-day personal loan delinquency rate was 57 basis points in the quarter, a decrease from 64 basis points in Q2, which is further evidence of surpassing a peak in Q1. Our personal loan annualized charge-off rate decreased to 3.52% from 3.84% in Q2, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 5.0% versus 5.4% last quarter. For our student loans, our on-balance sheet 90-day delinquency rate remained flat quarter over quarter at 12 basis points, while our annualized charge-off rate was 69 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumptions for personal loans in line with our underwriting tolerance. Similar to last quarter, we've provided a loan vintage analysis on page 10 of our investor presentation. Since this only provides a partial window into our loan portfolio, we're unlikely to provide the same analysis longer term. However, it's a helpful illustration of how recent vintages are collectively performing against our 2017 vintage, as this is the last time that we approached 8% life of loan losses at 7.85%. You can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 to Q4 2023 vintages, soon after we made material cuts to credit, net cumulative losses of 3.3% are well below the 4.8% observed in the 2017 vintage at the same point of 49% remaining principal balance. The gap between the newer cohort curve and the 2017 cohort curve widened slightly quarter over quarter.
Furthermore, looking at page 11 in the investor presentation, you will notice that only 43% of unpaid principal balance remains from our Q1 2020 through Q2 2024 origination.
Among the 57% of principal that has already been paid down, we've seen 6% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of more than 10%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at a 105.7%, 142 basis points higher quarter over quarter. This was driven by a 97 basis point decrease in the discount rate to 4.78%, which was directly driven by the drop in benchmark rates by 113 basis points and offset by 16 basis points of spread widening. The constant default rate, or CDR, also decreased by 28 basis points, which is consistent with the observed credit trends I just highlighted. For our student loan portfolio, the fair value mark increased by 183 basis points to 105.4%. This was driven by a 45 basis point decrease in the discount rate to 3.99% due to an 87 basis point decrease in rates, but offset by 42 basis points of spread widening. The weighted average coupon on the portfolio also increased by 17 basis points. The fair value gains in the quarter were significantly more than offset by our hedge losses and the negative impact from spreads widening. Net, we did not see a positive impact on the reported revenue from the change in marks, net of hedge losses and new originations. Switching to our balance sheet, where we remain very well capitalized. Assets grew by $1.7 billion as a result of nearly $1.4 billion growth in loans and approximately $226 million of an increase in cash equivalents, and investment securities.
On the liability side, member deposits grew by nearly $2.4 billion to nearly $23 billion, while overall deposits increased to $24 billion. We reduced our broker deposits by $445 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack.
Currently, there's a 220 basis points difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to more than $500 million in annualized interest expense savings, given the size of our deposit base. We exited the quarter with just $1.3 billion of warehouse debt drawn. This difference continues to support our net interest margin of 5.6%, underscoring the benefits of having the option of holding loans on balance sheet when advantageous in collecting net interest income. We continue to expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix shift towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.3% remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $6.1 billion and tangible book value by $236 million sequentially to $4.4 billion, with tangible book value per share at $4. Now on to guidance. For the full year 2024, we now expect to deliver adjusted net revenue of $2.535 to $2.550 billion, which is $85 million higher than our prior guidance range of $2.425 to $2.465 billion. This implies 22 to 23% annual growth versus 17 to 19% previously. This guidance assumes lending revenue will be at least 100% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow low to upper teens % year over year. We now expect to deliver adjusted EBITDA of $640 to $645 million, above our prior guidance of $605 to $615 million. This represents a 25% adjusted EBITDA margin. We now expect full year GAAP net income of $204 to $206 million, above prior guidance of $175 to $185 million, and GAAP EPS of 11 to 12 cents per share, above prior guidance of 9 to 10 cents per share. We now expect growth in tangible book value of approximately $1 to $1.05 billion and continue to expect to end the year with a total capital ratio at or above 16%. In terms of member growth, we expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q3 results. We continue to demonstrate our position as a durable growth story, which is reflected in this quarter's strong results. Despite operating in unpredictable macro conditions, we've maintained a clear focus on executing our strategy, driving returns, and helping our members get their money right. We could not be more excited about the opportunities ahead of us as we continue our journey towards becoming a top financial institution. With that, let's begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Hey guys, hey, great results as always. Can you give us some more color on the loan platform deals? Like, how do you make money here, and how does this differ from the prior quarters? Thanks again, great results.
Sure. Thanks, Dan. So overall, this is a great fee-based and capital-light revenue source for us. We're not taking balance sheet risk. We're generating meaningful cash fees upfront at time of transfer or referral, and we're able to serve the needs of more members at a more rapid pace than we've been able to do so before. So there are several ways that we make revenue within the business, which has certainly evolved since we started focusing on decline monetization in 2019. First is we send qualified borrowers to platform partners via our Lantern marketplace, and we receive a referral fee if the borrower takes out a loan. The second way we make money is we can embed the specific credit box of our platform partners into our underwriting engine and originate on behalf of those partners, with the transfer of those loans to the partner occurring shortly after origination. For that, we receive an upfront cash fee, and we also retain servicing. The third way, and what's new this quarter, is that we're able to originate on behalf of other third-party investors based on a specific asset characteristic and return profile of that investor, with loans transferred shortly after origination. This is within days or a week. We receive an upfront cash fee, platform fee for that business, and we also retain servicing. And then the fourth way that we can make money, and we've been doing this for a few quarters now, is we can service assets that we do not originate but are held on the balance sheets of other third parties. For that, we receive regular servicing fees that are not capitalized. What I would say is important is in all of these cases, these are assets that we wouldn't have otherwise underwritten unless contracted due to a number of reasons, including first, the credit profile and other characteristics of the assets, which may not be directly consistent with our current portfolio. Second, our own risk appetite may not align with those originations. And then finally, our capital allocation strategy at any given point in time may not align. The last thing I would say here is that there are no financing commitments or loss share agreements associated with any of these deals or partnerships.
And the only other thing I would add, Dan, and this may not be known by a lot of people, but we decline between 70 and 80% of the personal loan applicants to Sofi. And so there's a lot of potential, latent potential there to service them better. And so that's a big number that exists before we even try to do anything else in this business in terms of generating incremental demand or other initiatives to make people aware of the products that we can offer.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hey, thank you. Good morning. So your originations came in ahead of our expectations, and it's increased each quarter of this year. Credit seems to be improving sequentially, and the macro probably a little bit less clear than earlier this year. So I guess going forward, how do you think about originations and lending growth for your own balance sheet versus maybe originating for some of your partnerships?
Yep. What I would say is our overall outlook for originations, or at least growth on the balance sheet, has not changed. We do expect to see modest growth in dollar terms on the balance sheet year over year, and that will continue into Q4. We are happy with the size of the balance sheet that we have today and the amount of net interest income that we're generating. We are seeing excess demand both on the borrower side as well as the loan investor side for our unsecured personal loans. And we've been able to successfully navigate and fulfill that demand through the expansion of our loan platform business. So we would expect not to grow the PL balance sheet meaningfully from where we are today. Where we will migrate into is in a lower rate environment, you would see an uptick in demand for our student loan refinancing business, where we had a really strong quarter this quarter, as well as our home loans business, where we had our best quarter since 2021.
The next question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys. Congratulations and thanks for taking my question. I appreciate all the information, on the credit slide about the 17 vintage versus the more recent ones. It looks like, the current vintages are performing better than the 2017 vintage. I'm wondering, how do you guys think about that, the contribution of that performance trend to like return on capital, and how do prepayments or your just payment assumptions impact this outcome as well?
Yeah, thanks, John. So we often talk about underwriting to an 8% life of loan loss target, which obviously reflects the strength of our underwriting and the high quality of our borrower base. However, life of loan losses represents just one of several variables, which in combination actually drive our pricing and underwriting decisions designed to maximize return on equity while adhering to our credit risk tolerance. In terms of how we think about the returns on recent versus some of our past vintages, all-in returns on our more recent vintages are projected to produce meaningfully higher returns. I'm talking greater than 2x versus 2017, with newer vintages expected to produce ROEs above 30%. And I'm defining ROE here as the weighted average coupon minus annual losses, funding costs, and other operational costs, plus origination fees, and then multiplied by the weighted average life and levered. What's really driving those increases in returns is a function of a number of things. First is lower expected life of loan loss rates, as we show in our investor presentation on page 10. Second is the higher pricing beta throughout rate increase cycles. We've demonstrated time and time again that we've been able to maintain really good betas. We were successful in increasing the portfolio weighted average coupon across both products in a rising rate environment over the course of the last few years. And we've also been able to maintain pricing in down rate environments due to the quality of our product. The third way is we've had funding cost efficiencies given our higher reliance on member deposits and success in growing direct deposits and replacing higher cost warehouse funding. And then fourth, we've introduced origination fees over the course of the last year plus, and we're now generating close to $400 million in origination fees annually. So the combination of these drivers is more than offsetting the increase in prepayment speeds and the reduction in weighted average lives that we're observing in some of these newer cohorts. Going forward, what I would say is we're going to be talking about return metrics more often because these life of loan losses don't provide the full view.
And the other thing I would just emphasize, John, and everyone and the shareholders more broadly, is that we've been able to achieve these types of high ROE returns in more recent vintages, despite the fact that rates have been, increased significantly in a very short period of time, and the economy has been somewhat uncertain during that time period. As we look into 2025 and a declining rate environment and a stable economy, we think we can only improve on these returns, and it's one of the reasons why we're leveraging all the different businesses we are across the opportunity set that we have from a return standpoint relative to what we believe is a prudent level of balance sheet risk in a particular asset class such as personal loans. So we think there's a lot of upside and it only gets better from here.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, good morning. Could you just talk a little bit more about the expectations for the loan platform business, how you expect that can grow from here? I know you've said expect that to continue growing, but how meaningful can this become? It seems like, if we look at the numbers today, it's already at a $4 billion run rate. You've got the Fortress relationship, which, correct me if I'm wrong, is additive to that. So that's already $6 billion. And should we be thinking about the economics as close to a 5.5% take rate based on the revenues you reported this quarter? And then I'm just curious, are you going to maybe de-emphasize the loan sales a little bit more from here? I mean, it came in a little bit lower at the 375 versus the billion for the last 3 quarters, as you maybe prioritize the loan platform business from here. Thanks.
Yep. So I'll start and Anthony can chime in wherever. But in terms of the overall growth expectations, what I would say is as part of that $1 billion of originations that we did, Jeff, in the period, a portion of that did come from the Fortress transaction that we announced earlier in the quarter. So it's not additive to your $4 billion run rate. It's inclusive of that. But we do expect to see continued strong growth in the segment. We have that $2 billion agreement with Fortress, as well as commitments for Q4 and 2025 with several other partners. What I would say is we're one of the very few partners who can deliver assets at scale with the characteristics and return profile that investors are seeking. In terms of de-emphasizing other sales and ABS transactions in favor of this, what I would say is that demand is as strong as it's ever been before. Like I had mentioned a few questions ago, we're happy with the size of the balance sheet and the modest growth that we're expecting over the course of the next 3 months. But what I would say is that we are seeing excess demand both from borrowers and investors, and a way to fulfill that demand is through the LPB business. In terms of the take rate, what I would say is we're looking at apples and oranges when you're trying to compare this take rate to what you see in the general originate to sell business. These are loans that are originated on behalf of others, and they would not have been originated unless contracted to, given the credit care and overall asset characteristics of the loans, as well as our own risk appetite and capital allocation strategy. What we're receiving is a platform fee for our underwriting capabilities, our marketing capabilities, and our overall operational capabilities. And that platform fee will vary depending on the partner.
And I think, a couple of points just to emphasize. One is the partners in the loan platform business, many of which are new incremental partners on loans, as opposed to the wholesale loan buyers or ABS buyers that we've typically had. They're not all incremental, but a large percentage of them are, including in the most recent quarter. In addition to that, Chris has mentioned a couple of times, these are loans we wouldn't have otherwise originated. And we only originate when we actually have a contract. So it's not a zero-sum game, it's incremental, and the outlook for is pretty significant as we go into 2025 in excess of what you articulated.
The only other thing I would say in terms of, you had mentioned $375 million of sales done in period. We did over $1 billion across all three products in the quarter, and $6 billion over the course of the last 12 months in overall loan sales. Quarter to date in Q4, we've already done close to $1 billion in sales across our products as well. So the demand is certainly there. We will continue to fulfill on both ends. But as Anthony mentioned, being able to originate on behalf of others is purely incremental to us.
The next question comes from Kyle Peterson from Needham & Co. Kyle, your line is open. Please go ahead.
Great. Thanks, guys, and good morning. Nice results. Wanted to ask a question on deposits. Some of the trends you guys are seeing there. You guys had really nice growth there, despite I believe you took down the rate paid on member deposits a bit, as rates have gone down. So just any color on whether you've seen any changes in average balances or customer behavior, or if things have been pretty receptive to some of the changes you guys have made on deposit rates kind of early on in the rate cut cycle.
Yeah, we're really proud of the way the SoFi Money product continues to resonate in the marketplace, despite rates coming down more broadly. We've maintained our market share position. We've maintained our ranking in an APY standpoint. Of course, we do not charge fees. We obviously give a number of other benefits, including the high interest rate, not to mention all the functionality you need in one place. So we've seen continued strong trends in deposits. Over $2 billion of member deposit growth in the quarter. In addition to that, the spending levels that we're seeing are on par to better to where they have been historically. And so we're continuing getting positive indicators across the entire business as it relates to SoFi Money. The other thing I would just mention is this is one of the key points of where the flywheel starts. Our direct deposit customers are customers that are more engaged. They have meaningfully higher number of products per customer compared to the overall average that we report. And when you look at it on a vintage basis, it's even better than the overall average number of products per direct deposit member. So it's been over a year in which we've operated this business as a bank and been able to control our own destiny and having a competitive advantage in being both an origination platform on loans, as well as a national bank that can set its own interest rate and its own value proposition. It's a competitive advantage and one that's continued in the quarter, and we're excited about next year.
The next question comes from Mihir Bhatia from Bank of America. Mihir, your line is open. Please go ahead.
Good morning. Thank you for taking my questions. I wanted to stay with the financial services segment again. And I wanted to just talk about a couple of things there. One is just about monetization in the segment. I think it's up to $81 annually now. Any targets you can share on what you think that can look like maybe this time next year, or just, to achieve your 3-year targets that you laid out? Like, how much more monetization can that be? And then just related to that, I guess, what is the next growth there? You mentioned SMB and Protect in your remarks. You also launched the credit card more broadly. So maybe talk to us about where that next growth vector is materializing from. I guess really what I'm asking is what's the next lending platform business in that sector, right? Like I think it was a pretty big surprise for a lot of people how much that business grew this quarter. So give us a...
You've hit the nail on the head, and thank you. You've hit the nail on the head. It's an exciting part of our business. The fact that we're approaching, $1 billion annualized business, very profitable while we're still in investment mode. It's pretty amazing to have a business of that size, $238 million of revenue, growing over 100% and profitable, despite how fast we are growing the number of members and products and revenue per product. And I think the best way to sort of conceptualize where this business could go is to think about those three variables: member growth, product growth, and revenue per product. The revenue per product that we generate today was up meaningfully in the quarter, as you mentioned, but it's nowhere near where it can be long-term. As it relates to our invest business, we're monetizing at about half the rate that we think we can monetize it over time. In 2025, we'll take a number of steps where we start to monetize that better, of course, by adding incremental value to the invest experience. Our invest product is unique in that we're trying to be a one-stop shop just within invest. We pioneered fractional shares. We obviously don't charge on trades. In addition to that, we created our own ETFs that would better meet the needs of our new and beginning investors that are lower price point but diversified, allowing our members to do dollar cost averaging in a diversified way. We have award-winning robo accounts, and we continue to evolve those, and you'll see us do more in 2025 behind that, to not just grow assets, but also to increase monetization. We do IPOs, which is a direct monetization vehicle, but again, a unique product where Main Street investors get access to IPOs at IPO prices. And then our alternate asset classes and mutual funds that we launched have really been a tailwind for us in terms of driving more engagement. That's something today that we don't monetize that we will monetize in the future. So just in the invest business, we have a over 100% opportunity to increase the monetization per member, not to mention the fact how fast the products and invest are growing. And remember, when you do the calculation on invest product growth, you have to normalize it for the lost crypto members or products that we had a year ago that were transferred. SoFi Money Business, we continue to see nice trends in deposits and spending, and the monetization there will continue to improve with more deposits and more spending as opposed to a change in rate per se. In addition to that, our credit card business is another source of monetization opportunity. As balances continue to increase, we'll have more monetization there. In addition, the more members that we add, the more monetization that we drive, because that's a higher interchange revenue than our debit interchange. And so as you see a mix shift, you'll see an improvement in monetization there, not to mention just the absolute increase in monetization. And then as it relates to small and medium business, we're just scratching the surface. The biggest initiative we had so far in 2024 was to take the application process and embed it into the SoFi app. So when all the demand that we get for small and medium business comes to SoFi, they can, within the native app, apply for a loan and then be referred to a partner as it relates to lending. We also do that as it relates to banking. You'll continue to see us do that in a much bigger and broader way. There is monetization there today, but we could do more products and more services to drive greater monetization, not to mention doing it ourselves at some point, which we would like to do over time. It is a early stage business, and we want to crawl before we walk and then ultimately run. So you'll see that in the SMB business. On the insurance side, the deals that we're doing in the marketplace increase our monetization there, but it also increases penetration. So over 100% revenue growth in the quarter, driven by the really strong product growth and revenue per product. And if you just focus on those two measurements, you'll be able to forecast a pretty sizable business with great profitability. The last point I make on profitability is we're still losing a large amount of money in the credit card business and invest business because the payback there is longer. And it's not a business that we get return on in 1 year. It takes anywhere from 1.5 to 2 to 3 years, depending on the J curve of the credit business. So what's masking the profitability is that investment there. If we actually added back the losses that we're losing there, the number would be even bigger on the profitability side. And that's before we've improved any of the monetization.
I found this on the web.
The next question is from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Nice trends here. I was just curious, a bigger picture, can we talk about what you're seeing in the alt credit side? Private credit certainly becoming a theme. Some of your marketplace lending peers have also benefited here. In your discussions, pipeline, just just curious if you think this emerging as a larger theme over the next 12, 18 months. And then finally, as it relates to tech platform performance pipeline, can you talk to the degree of decision delay you're seeing currently versus last quarter? Thank you.
Yeah, in terms of the demand for our loans from buyers or investors, similar to other people, the demand has increased quite meaningfully. We are better at being able to meet some of that demand by continuing to evolve our business from origination platform for our own loans and now the evolution of the loan platform business. So similar to others, we're seeing an increase from existing buyers, but also a number of new partners that we've not been able to meet their needs with before, but we now can. So really excited about declining rate environment, putting a tailwind behind the loans, not to mention our new initiatives there. As it relates to the tech platform, no decisions have been made by any of the big deals that we've been in process with over the last 12 to 18 months. I do think we're coming to the end of some of those decisions being made, and I would just say that we haven't had anything to announce, but I would just tell you I'm confident that we will have some wins there, but none of the decisions have been made on any of the large deals. And I would just give you more color on the types of deals. There are definitely big financial institutions that have to make some decisions on their technology. They continue to really struggle with how they budget for that transition, but without a doubt, there's a technical reason why they have to switch, there's a risk reason why they have to switch, and there's a regulatory reason. And so it's going to be an inevitable change and tailwind to the demand for technology like we have in our tech platform business, and specifically in core and processing. And it's just a question of when, and I think we'll win our fair share of deals there, but none have been decided yet. The second area that we haven't talked as much about in the past is the opportunity to help large branded companies that have big installed bases. They're in the financial services business already today through a credit card and a white label credit card. There's absolutely a significant amount of demand from those types of partners for us to do something very similar on the debit side of the business. And we continue to receive RFPs for that type of product. And then, of course, outside of the direct-to-consumer businesses, there's demand from government agencies, there's demand for B2B companies that continue to surface, and some of which we've signed and executed against, some of which will be decided over the coming months.
Damn.
Next question comes from Jill Shea from UBS. Jill, your line is open. Please go ahead.
Good morning. Thanks for taking the question. You launched the Everyday Cash Rewards and the Essential credit cards while early days. Can you just talk about the early indications there and your view of future growth on the card products?
Yes, we really like the card business long term. It obviously is an expensive endeavor near term. There's a J curve of about 3 years in that business. We have a world-class team that's done this before. That wasn't the case when we first launched. The 2 cards that you mentioned are a direct result of all the work the team, our second team that came in to run this business has done. We did a test with the business. We saw the type of performance that we were hoping to see. Our marketing capabilities there have also helped us deliver the type of performance we wanted to see in those cards, and that's why we went general availability for those cards as opposed to just testing. I will say we will take a very methodical approach to the credit card business. While it is a great ROE business, it also does have the ability to lose a lot of money and lose money every day. And so we'll continue to make sure that that card is something that we market to individuals that we think have a high probability of utilizing it in the right way, and we can get a great return on it. So we'll start with our members, and we'll continue to use the data that we have on them to make decisions. We can use that data to model opportunities off of our platform, which we are starting to do as well. Inside of the financial services business, think about it as a couple of different types of segments. We have businesses that are still growing very fast that are profitable, like SoFi Money. We have businesses that are growing very fast and are losing money, like Invest and Credit Card. And then we have businesses that are early stage, and we're planting seeds that will continue to be harvested over time and grown over time. And this is a business that's in the middle, one that we feel we're confident in terms of our go-to-market, and one that will grow, but we'll do it methodically over time to make sure that we do not push too hard on the investment we have to make and offset the profitability of our overall business. But it'll be a good contributor.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Close it.
Thank you, operator, and thanks for everyone that's dialed into the call. I have some closing remarks I want to share. As I mentioned at the end of Q2, I could not feel better about what we've achieved and where we're headed right here and right now. The list of achievements is far too great to capture every quarter, so let me be succinct and clear. Despite the tumultuous environment of the past 7 years, we've delivered durable growth, world-class innovation and brand building, and improving returns with 17 quarters of record revenue, consistent 35% plus growth in members and products, 4 quarters of GAAP profitability, and so many other milestones. There is only one reason we've been able to emerge stronger from such a tumultuous environment, and that reason is the people of SoFi, our employees, our members, and our clients. I could not be prouder or more grateful to the people of SoFi. We now face, hopefully, the most advantageous environment that we've seen since I joined the company, and we began the relentless march to be a one-stop shop. Today, we are no longer just a lending company. Today, we are a force to be reckoned with. It is truly our time as we have more products, more members, more capital, and more diverse revenue streams than ever before. We are undeniably the absolute best positioned company to capture the massive opportunities still ahead of us because of the same thing that got us here, our people. Our people are great at heart. Thank you, everyone, for your time today, and we hope you have a great end to 2024.
That's it.
Goodbye.
This concludes today's conference call. You may now disconnect.
All right, guys, that's it. All right. The stock is not red. It's not red. It's flat. Guys, you know Anthony Noto, he knows what's going on. He hit the 4 quarters of profitability. Now they are taking the stock to $18. He knows what the requirements are. He knows the minimum market cap. It's $18 billion. We're going to $18 per share. I'm not exactly sure when, but I can tell you right now, this stock will be higher than where it is today after elections is settled and over, maybe a week after elections. We will be higher. When is elections? What? A week and a half? We're going higher from here. They have more diverse revenue streams than ever before. They have scaled their members almost to 10 million. They're going for the 1 million member mark. They just jumped their quarterly revenue up $90 million. Look for any SaaS stock under $30 billion. None of those companies are doing that. We're going to jump, I don't know. I mean, we're going to be jumping like $150 million a quarter next year. And I think they're going for the $100 million profit for Q4. I don't even want to think about what the numbers are going to look like, but this is pre-market, guys. There's extremely low volume. You may see, a sell-off, but I expect dip buyers to come in very, very quickly. You heard they got 2 small Mexico legacy bank partners, and they're trying to finalize the deals for these large legacy banks, which we would likely hear in the next couple of months. He said they're going to see some wins there pretty soon, but he let the analysts know that there has not been any large announcement yet. So that's it, guys. Triple B blew my expectations out of the water. You heard Anthony Noto. This is the best quarter in company history, and that's it. So, you'll see more YouTube videos on this channel for the breakdowns, covering the earnings. But day-to-day price action, pre-markets, you just don't know what's going to happen. But I think the stock's going to go a lot higher. So thank you guys for joining the stream. Smash the like button, subscribe to the channel. We'll be giving you more content. Have a great day.